Investing, especially as a young person who is just starting, can be very intimidating. You see all these YouTubers, all these influencers telling you what to do. And I think the most important thing you can do is keep it very simple for yourself and to not go on Wall Street bets. And so what I think is personally the best way to get started and invest your money is any one of these all-in-one index ETFs. I'm from Canada, so personally this would be an XEQT or VEQT. I'm pretty sure in America the equivalent would be VT. But what these are all-in-one index ETFs where you hold stocks from all around the world and you hold an insane amount of stock. I'm pretty sure for XEQT, it's around 7,000 stocks are held in this ETF in total. And so what you're able to do is buying this ETF, you're actually buying these 7,000 companies, which you cannot do unless you have a massive amount of money to go and buy all these companies, and it's extremely complicated. And what these ETFs do is they make it very accessible, simple, and easy to buy all these companies. And this eliminates a lot of risk that's associated with investing because, for example, if one of these companies gets involved in a scandal and they go bankrupt and their stock goes to zero, it's actually only making up such a small percentage of your portfolio. You will not lose that much money because all these other companies that you are invested in are still maintaining their value and going up. And so you're basically playing the mean and playing the average. But not only that, you're invested in the biggest companies in the world. It involves Microsoft, that involves Google, that also involves oil companies, that involves gold mines in other countries. So you are so diversified that the risk you are taking on is much less than if you're picking individual stocks. One thing to note is that to provide this service to you, they do charge fees. They're not like an actively managed mutual fund. So the fees end up being pretty low, around 0.1 to 0.3% on average for most of the ETFs. And this is actually a very, very low cost. If you had $10,000 invested at a 0.2% fee cost, you'd only be spending about $20 a year. So in the grand scheme of things, to be able to hold that many stocks, it is definitely a good deal.
I was a businessman doing business.
To just speak to how well these all-in-one ETFs perform, historically, these broad global stock market ETFs, they return around 7 to 10% per year on average, and that is before inflation, which is an incredible rate of return. And if you invest $1,000 and you make 10% on that in 1 year, you've just made $100, and that can compound over time. And it just shows how good it's been performing. And this is on average, not even just the best year. On average, it's been returning that. So it just shows how important it is to invest when you have the available funds. And if you aren't investing, you are just missing out. And what this ETF does is this gives you a very, very diversified investment opportunity that is incredibly simple and cheap. And that is why these are so powerful, is that you don't need any knowledge, you don't need any specialization, you don't need to have a lot of money. You just need to have a brokerage account, which is free, and most of them offer commission-free trading. And then you just put whatever money you feel comfortable with into these ETFs and you're done. You just let it sit. You can turn on dividend reinvestment. You can put all your money in there. You don't even have to think about it. You don't have to think about, oh, is this stock a good opportunity or should I invest in something else? No, you just buy everything. You buy all the stocks. You buy all the big stocks from across the world. And so you're so diversified, and so it is just an incredible opportunity, and you should get started right away. And another thing I want to mention, as someone who's young or new to investing and has not done a crazy amount of research, there is no reason to think that by picking stocks, you are going to make more money than these all-in-one index ETFs. There is been a ton of research. There's people working for these billion-dollar companies where they've gone to school and they've worked their whole lives to try and have a little bit of an edge in the stock market to make more money. And even then, most index funds, most professional stock pickers can't even beat these broad market ETFs. And so to think that you can, with less resources and less knowledge and less education is kind of crazy.
If you could take
Okay?
6
You're not
feet-
that guy, pal. Trust me. You're not that guy. Okay.
And one other advantage of this ETF is that you have one holding, you see one number. Whereas if you had picked, let's say, 10 individual stocks, you might have one stock go up 30% and the other go down 30%. And that brings in a lot of emotion, and it takes a lot of self-control to not be overreactive and make mistakes. A big part of investing is how you can control your emotions, because at the end of the day, the stock market fluctuates so much on a day-to-day basis. You could be up 2% one day and then be down 4% the next day, up 1% the next day, and all that you've gone down like 0.5% or 1%. The market is so volatile on a day-to-day, week-to-week, month-to-month basis. In 5 years, all those little fluctuations over these short periods of time, they really have no meaningful impact on your return after 5 years, which is why we are investing. So by looking at these things every day, you're really just playing at your heartstrings. And I'm speaking from experience. I've definitely had periods of time where you're like addicted to checking your brokerage account and just seeing, oh wow, look, I made $200 today doing nothing, and like you feel great. And then the next day you lose $200 and you were doing nothing, and you feel awful. And it is really hard to manage these kind of emotional swings. And that is a big reason why a lot of people can't sort of handle investing. It to a certain extent on the day-to-day, it is like gambling. You have no edge or insight whether the stock market is going to go up this week or down this week. And there are huge monetary impacts based on that. But you have to realize that over the course of a year, or over the course of 5 years, all that stuff averages out, and you'll see those sort of annualized returns that you expect. But if you let that get to you and you see you're down $500 and you panic sell because you can't believe you lost all this money, you're now going to miss out on the upswing that you're going to have in the next week, and you're going to take your money to the market, which is proven on average to yield good returns. And so you kind of hinder yourself. And so what I would recommend, I know it's tough, I can't even do this, is that you invest your money, you put it into these all-in-one index ETFs, and you, in a way, like delete your app. You do not check it. The best thing you could do when investing is to put your money in these ETFs or invest your money and then never check it, never look at it. Don't even bother. Maybe check on it once a year just to see how you're doing, or if you need to sell some, buy some. And it's good. You can even automate stock purchases. So if you're investing 25% of your paycheck, in most of these apps, you can have it set to automatically invest into any stock, whether it be this ETF or something else. And then you can automatically do that, so you don't have to actually be involved and looking at your account. So that is a very important thing to consider when investing. Now, if this is money that you might need in 5 years, which is considered a pretty short time horizon in investing, or you're just generally a risk adverse person, or you don't feel comfortable getting started having it all and dealing with the swings, what you can also do is mix these all-in-one equity ETFs with bonds or money market funds, which are essentially kind of like high yield savings accounts. A money market fund is basically a high yield savings account where you can buy it, the value of your money maintains, and you make a fixed amount of interest. Bonds are a bit different, but they also kind of act as the same thing, where they act as a cash buffer where you're making interest on your money. And so what this does is this mutes the fluctuations of the stock market, because if you had all your money in equities, in stocks, and they go up 1% or down 1%, all of your money is going up 1% or down 1%. Whereas let's say you had 50% in stocks and 50% in bonds, and the stock market went up 1% or down 1%, you're essentially only going up 0.5% or down 0.5%, because half of your money is in these bonds, but they still do make interest and you still will make money. And another advantage of this is if there is a big sell-off, you are able to sell those bonds, invest them into the stocks or the ETFs, and essentially lower your average cost and buy the stocks at a discounted rate. So it also ensures that you have some money set aside in the event of a of a big crash or something, that you have some cash that's available to purchase at a discounted price. Whereas if you were all in equity, all in stocks, you would not have that opportunity because you wouldn't have the cash in hand. Now, for young people, it's definitely recommended that if you don't need the money in the near future, to put it all in stocks, because the risk of the stock market underperforming bonds is very low over a long-term horizon, because the stock market averages around 7 to 10% per year on average before inflation. And so usually it's recommended to have it all in stocks. But again, if you have a shorter term horizon, or you're a very risk adverse person and you don't feel comfortable being in all stocks, you can offset and allocate a certain percentage of your portfolio to be in these money market funds or bonds. Well, that does it for this video. I hope you guys were able to learn something or find this video helpful in any way. If you guys are invested in the stock market already or are about to invest, let me know what you guys are buying. And if you enjoyed this video, please don't forget to subscribe and like. And if you have any video topics or anything you want to see in the future, comment them down below and I will try to get to them. And I'll see you guys in the next video.